Hey, Devon, thanks for joining me
Hello,
today.
you're welcome.
Yeah, so I invited you on here to talk about recasting loans because something that's coming up a lot right now for me is that I have buyers who are sellers who have a house to sell and they are trying to get under contract, and it's just super hard to do because they cannot compete with the buyers who do not have home sale contingencies. So
Sure.
recasting loan is something that I know of, but I don't know very well how to explain it to my clients, and you're the
Okay.
expert.
Okay. I will tell you about them. So essentially, what a recast is a way to go non-contingent. So what you're going to want to do is, there's a lot to it, but it's simple at the same time. So you do have to be able to qualify for both payments for the current
Okay.
home and the new home. That's the kicker. So, but what you can do is, if you don't want to go contingent, because the seller of the home you want to purchase will not accept a contingent offer, what you do
Right.
is you set up on a recast with me. So I'll get you pre-approved for both, essentially. So you'll be approved for the home you're already in, and then if you can get approved for the new home, now you can pull money from a 401k, you can get a home equity line of credit to get the down payment. You only need a minimum down payment. So let's just say if you're not going into jumbo, this does not work on jumbo loans. It only works on conventional loans.
Okay.
It's not for government loans either, like FHA, VA, or USDA. So it's only a
Okay.
conventional loan product. But with conventional loans, what you can do is you either have the money pull out of a 401k, or you have it in savings, or you get it from a home equity line of credit, or wherever you get it. It can even be a gift from a family member. Then we can use that money to buy the new home,
Mhm.
assuming they make enough money to qualify for both payments.
Right.
So you'll come in on the new one. Let's just say you put 5% down. You buy a $650,000 home and you put 5% down. So that's what's going to be now your down payment for the new one. So as long as you can qualify for that payment and your existing payment on your departure property, you can qualify for the recast loan. So the recast loan, you'll pay a $300 fee for, and then it will retain that loan on our books. We won't sell it off our line
Mhm.
until you close on this loan, move into the new house, and then decide to sell your departing residence. It could be a day, a week, a month, a year, 5 years down the road. There's no limit on when this recast has to happen.
Oh,
We'll hold
okay.
it on our line until that day comes. So whenever you sell your departure property, let's just say it needed some work. So you moved into the new home, and then you had to go back and put carpet and paint and a new roof and all this other stuff that needed to be done. It took you 8 months to do it.
Mhm.
So while you were getting all that done, you're making payments on both homes, which is the not fun part.
Right.
But as soon as you do get that home listed, when it sells, whenever that is, you can take those proceeds, apply them to your new loan, and recast the loan without having to incur the cost of a refinance. So a
Okay.
refinance has the same fees as a purchase. I mean, it's not much different. They're relatively close to the same. So you can pay 5, 6, 7 grand in fees to refinance. And
Mhm.
so to do the recast, you're only paying a one-time $300 fee.
Mhm.
So it's way cheaper than a refinance, and
Mm.
way cheaper. And then what we can do is, we just when we you let's just say you sold your home, that your departure property, and let's just say it was 500 grand, you owed 300 grand, and you walked away with 200 grand profit. So you could take that 200 grand profit, go apply it. You put 5% down on your 650 loan for your new home. So you can take that 200 grand, apply it to that loan. We'll recast it, meaning we'll drop the mortgage insurance because now you'll have your 20% down.
Mhm.
Well, the interest rate won't change, but we'll lower the payment
Okay.
because all those proceeds will get recasted. So you're not. So typically, what happens if you were to do it without recasting, you would sell the home, buy the home deal, and then you would take that 200 grand, you'd apply it to the home, and nothing would change. Your payment would
Mhm.
remain the same. So
Right. You paid it
you just
down,
pay off the
but
home
you've
sooner.
paid down your principal, but it's not changing your loan structure.
That's correct. So you
Right.
would just pay it down sooner, but you still have the high payment. So if
Mhm.
you had mortgage insurance on it, you're still going to have mortgage insurance,
Yeah.
right? You'd have to
Yeah.
wait that either 1, 2, or 5 years, however long it takes for whichever servicer of the MI mortgage insurance makes you keep that before they'll allow you to challenge them with an appraisal and get rid of it. There's
Uh-huh.
set timelines, and there's like 7 MI companies, mortgage insurance companies. So they're all different on how long they require you to keep the MI, the mortgage
Mhm.
insurance, prior to letting you eliminate it through challenging them with an appraisal to prove you have your 20% value.
Right. Yeah, yeah.
So that's a recast, in a nutshell, is that it's
Okay.
just a way for you to buy the new home without having to be contingent on selling your departure property.
Right.
And
Okay.
then for that $300 fee, you're essentially refinancing whenever you do sell that, and applying those funds and then lowering the payment getting rid of the mortgage insurance. Now the interest rate can decrease, but it'll be decreased on the same day's rate sheet that we locked. So what I mean by that is, so if you got into the new home and we locked your new home today, and then 6 months from now you wanted to do the recast, it's
Uh-huh.
not on that day's rate sheet. It's on this day's rate sheet when we locked it.
Okay.
So if pricing was at 5% today with 5% down, and you ended up putting another 20% down, and you had 25% down, well, it would recast that on that day's rate sheet.
Okay.
So because you're going to get, the more money you put down, the lower the interest rate.
Right. Yeah.
So you had 5% down, so it's going to be higher initially, and you're going to have mortgage insurance initially. The payment's going to be high until you sell that departure property and apply those funds.
Right.
But when you do, the mortgage insurance goes away, the payment lowers, and the interest rate will go up to the level on the day we locked at wherever it was for a 25% down payment.
Okay.
Because you put
so
5,
the day
now
that
you're
you
putting
lock in, like, let's say your loan is like, you're doing a 5% down payment and you are locking in the rate on this day. And then 4 months later, you are recasting your loan, but you are looking at the rate sheet for the day that you locked in.
That's correct.
Right. Okay. Just want to make sure I understand.
So you're locking in that day's pricing.
Right. So then if you're putting 20% down now, your rate should be lower.
On that day's pricing, it will go lower, but it's not going to be on today. So if today we locked in, it was at 5% and it was 6% when we did the recast, you're not stuck getting the better rate on the 6% and dropping it. You still get it on the 5%, but it can work in the other direction too.
Could they choose you, and you can't pick and choose?
Unfortunately not.
Okay.
No. So that's the potential downside, not in this environment, but in some rate environments. In this one, you're obviously safe. We got 6 more rate hikes coming this year. Now, most of that's already been built in because investors do futures. They understand what's coming and they build it into the rates. That's why they've gone up so quickly in the last couple of months.
Right.
But there is a chance that in a different market, this could work against you. And so if you locked at 5% today and it was at 4% 6 months from now, you're still stuck at that day's pricing.
Right.
So right now it's a huge asset, but it could be a liability in a different market.
Right. And one question I had, what is the minimum down payment for conventional?
5%.
5%. Okay.
It's 3% if you're a first-time home buyer, and first-time home buyer just means you haven't owned a home in the last 3 years.
Okay.
And there are a couple programs that will allow that. I think it's Fannie Mae and Home Ready. I think those are the two that allow it. But the interest rate's higher, the mortgage insurance is higher. I mean, 3% is just not a good way to go unless it's the absolute only option you have.
Right.
You always want to try to come up with 5%, even if you're a first-time home buyer, because the mortgage insurance and the interest rate drop considerably.
Right. Okay, cool. I think that that's enough information to get people started who are in this position that they're looking for a different house and they're just not getting their offers accepted. This is a viable option if you can afford both payments. What is usually like the debt to income ratio for your payment?
So you have to have both payments fit in a 50% debt to income ratio. So that is all of your minimum payments on your credit report. So any of your student loans, your car payments, your credit card payments, those minimum payments with both of the full PITI-MI, principal, interest, tax insurance, and mortgage insurance, if applicable. Those two payments plus all the minimum payments on your credit report have to be 50% or less of your gross monthly income.
Right. So, and your gross income means your income before taxes.
That's correct. The bigger number before the taxes are taken out is what we use.
People should be able to like look at what they're making and see, okay, well, right now my payment is only half of my gross income every month on my house. So I should have some wiggle room to, maybe get another loan and recast it later.
Yeah. So if somebody let's just make up a simple number, 10 grand a month in income. So a 50% debt ratio would be 5 grand a month, right? They can use half of that income for their debts. So if they have a house payment at $1,500 a month on their first one, there's 1,500 of that 5. And then if they got a new house payment, let's say of 2,000 for their next house they're going to buy, now we're at 3,500. So as long as their credit cards, car payments, those kind of things, student loans, in second homes, whatever they have on there, as long or boats, RVs, whatever it is, whatever minimum payments on your credit report, as long as that fits in the remainder to keep it under the 5 grand a month, then the 10 grand a month income, half of that is your 50% debt to income ratio, then you'd be able to qualify for both homes. So this is essentially, it's a workaround for companies that don't offer bridge loans. is what the
Okay.
recast is for. That's
Yeah.
the term in the 80s. You heard all the time, everybody just do a bridge loan, you
Right.
know, and there are still a couple companies that do that, but they're very hard to get done, and it's rare that people are
Mhm.
offering them anymore. It's a very complex product, and so most companies are not offering them, and most aren't
Mhm.
even doing the recast. So
Mhm.
there are a couple that still do them, but a lot of them, like WaFed is one, and they do like state to state. It has to be the same state. So if you
Mhm.
moved to Oregon to Washington, it wouldn't work. It has to be Oregon to
Oh,
Oregon or
okay.
Washington to
That's good
Washington.
to know.
So
For
there's
recasting, it has to be state to state.
no for
Oh,
the
for bridge
bridge.
loans.
For the
Bridge
bridge.
loans.
Yeah. For the recasting, you're fine. There's
Okay.
no, it can be, that's another benefit to the recast. And again, in this market, it's a really wise thing to do
Right.
because you're locking in that rate sheet, and most likely they're going to go up by the end of the year. So the longer you wait to sell that home, the higher rates go, the better off you're going to be by exercising this recast,
Yeah.
because you're going to be locking in a price way lower than potentially where it could be months from now.
Mhm. Because that was going to be my next question. And then I'm going to cut us off because I'm trying to keep it short.
Sure.
Is what's like the benefit of doing a recast over a bridge loan?
So, well, the bridge loans, if you can find them, and they work for you, then go for it and try to find
Uh-huh.
one. I mean, they're a good option if you can find them. So the benefits are most people don't offer them, and we do offer this. So it's
Right.
an available tool that's readily available, and it's
Mhm.
easy to use, and it's very inexpensive.
Mhm.
Those are the benefits of it. And in this market, again, it's a really good thing to do, because
Yeah.
in a different market, you wouldn't even need it anyway, because they're going to accept contingent offers,
Right. Yeah.
right? In a different, so it wouldn't
That's just not
matter.
how it is right now. Yeah.
It's just not how it is right now. And this is where these come into play, and why we're doing so many of them right now is
Mhm.
for this reason. And what a lot of people are doing, I'll try to make it quick, is
Mhm.
they'll go get a home equity line of credit, and then
Uh-huh.
instead of taking their 50 grand for a down payment, they'll take 60 grand. And now they've got money to feed that other home until it sells.
Right.
So they're not making two payments essentially. I mean, they are,
Mhm.
but they're making it out of the equity. So they don't feel it out of their monthly income, because
Right.
they borrowed it out of the equity of the
Yeah.
home they're going to sell.
But they're going to feel it when they sell that house.
They will. The extra
Yeah.
10 grand will be gone, but it's another way. I mean,
It's
in
a good
this market,
option.
it is. And
Mhm.
in this market, you probably already made that up in 30 days in your next
Yeah.
home. You know
Right.
what I mean? Just by
And
living
to
in it.
do a HELOC, you have to. So to do a home equity line of credit, do you have to refinance?
That is considered a refinance. It's just a second lien position. So a
Okay.
refinance typically is your first lien position. You're going to redo your first mortgage, the one that your purchase loan that we got you into.
Mhm.
That's what a refinance is. You're going to get rid, like you start with FHA, you have
Right.
mortgage insurance, you build up your 20% equity, you refinance it to get rid of that mortgage insurance, and you go
Mhm.
into a conventional loan. So
Right.
that's typically how that works.
Okay. Awesome. Well, thank you so much for your time.
You're
Appreciate
welcome.
it. I'm going to put your contact information below in the description so someone
Okay.
can reach out to you if they're interested in learning more about recasting
That
their
sounds good.
loans. And yeah, awesome. I'll put your email in there too. So people can email you or call you.
That sounds good.
All right.
I
Thank you.
appreciate
Have
your
a good
time.
day.
Thank you. Bye-bye.
Bye.